So I've been trading for nearly a decade now, and over that time frame I have made multiple mistakes inside my trading journey. So I'm now going to compress my trading journey into an 8 to 10 minute video so that you understand the fuck ups I made along that journey and how you don't have to make the same mistakes I did. You might be wondering why I'm here and taking my time, effort and money to create YouTube videos just for you. And the main reason is I want to help you compress your trading journey down to a smaller time frame and hopefully help you reach the goal of becoming a full-time trader and quitting that 9 to 5. So as I previously mentioned, my trading journey was 8.5 years in February, and over that time frame I've had plenty of hurdles. We previously run a service-based business that done 650k in revenue, which we then understood juggling trading to running or working in a business and then also having a full-time role as a trader. You understand that the end result is really worth it. So if I was to start my trading journey again, these would be the top 3 things I would want to master to bring me to my final goal of becoming a full-time trader. Number 1, that would be risk management. So risk management is a really big part of trading because it's basically how much you're going to risk on each trade you put down. And the simple answer of that is what you should risk. We have found I run at 5% when I first started. We dropped it down to 2% risk on every trade I placed, and finally found the sweet spot for personal capital was 1% risk on all trades you placed. So you should only be risking 1% on all trades that you're placing, if that's demo or live accounts. And the reason this works itself is mainly due to the amount of trades you're placing, as well as if you're going to look to further on step into funded trading accounts. So we'll look at funded trading accounts and why that doesn't work with bigger risk to reward ratios. So if you don't know what a funded account is a company that will fund you as a trader and they take a split of the profits. But there are rules and rules we have to stick to, and that normally is a 5% daily drawdown limit. So if you place, let's say, 3 trades and you've got 2% on each trade and all 3 trades hit stop loss, you're going to be minus 6% on your trading account. Well, that then has exceeded the daily limit and that account will now be taken from you. Same again, if we was looking at placing 5% risk on trades, you would hit the same problem. So 1% hits that sweet spot where you would never be having 5 open trades per day. Well, you shouldn't at all really, but what that then allows us is to have a little bit more room inside the trades we are and not be anywhere near that daily limit. Again, we also then have a monthly drawdown limit of 8 to 10%. So if you're still risking 2% a trade and you have 4 losing trades in a month back to back, which as a trader is very easy to do, you can have 4 losing trades and still be a profitable trader. You're still going to hit that monthly drawdown limit and get the account taken off of you. With live capital, that's slightly different because live capital is only what amount you're losing. I've got a 100k trading account, which is a live account. So if we risk 5% on a trade and I lose that trade, I'm going to only lose 5% of my trading capital, which would be 5,000. We don't do that, we only risk 1%. But for an example, if we was going to do that, I've got no drawdown limits, but if you lose 4 trades in a row at 5%, you're going to lose a massive amount of your trading capital. So now you understand you should only risk 1% ever on your trading capital and never sway away from this inside your trading. Let's now have a look at risk to reward ratio and what that can do for your trading. So risk to reward ratio is the amount you are risking, 1%, to the amount you're going to get back. So if we're going to show you an example here, we're looking for long positions on trades. So we're going to set a long position and we're going to have a 20 pip take profit and a 20 pip stop loss. So that there is a 1-to-1 trade, and that is a not negative but not positive risk to reward ratio. So we don't want that because we don't want to be risking 1% to gain 1% back, because we have a really good strike rate on all trades. We've got a 100% strike rate on trades, otherwise you're not going to make any profit. So we're doing an example here on 10 trades at 1-to-2, an example on 10 trades on a 1-to-4 risk to reward ratio. I'll show you what that looks like now. 20 pip stop and we're going for a 40 pip take profit. So there is a 1-to-2 risk to reward ratio. Now if we're going to do the same thing again, we will look for a 1-to-4. So we're going to have in a 20 pip stop loss And that then is just a nice easy, go 20, it's a nice easy round number. 20 pips is quite small for a trade, but that's what we're going to look for in this example. And we're going to run to a 1 to 4 on that account. So there we go, we've got a 1 to 2 and a 1 to 4 risk to reward ratio setups in front of us, and you can understand the difference and see what I'm talking about. So let's have a look at 10 trades. So if we had 10 trades as an example, and we looked at that we was going to place 10 across that. So for my trading and my strategy, I would lose 5 of the 10 trades placed. Yeah. So first of all, we're going to then have, if we come down it, we're going to have minus 5% on the 5 losing trades. I'm going to have 2 trades that then are going to hit break even, because I put stop loss to entry at, depending on the trade, +1 or +2% in profit. So then we're going to have 2 trades there, which is going to be 2 at break even. Where is the at sign? BE, break even. And then we're going to have 3 trades that are winning. Yeah, so we're going to have 3 winning trades. So that then at 1 to 2 is then going to give us a 6% profit. We go plus 6% in profit there. So in theory, that's going to equal to that we've placed 10 trades, and all we're going to make, we've lost 5%. Yeah, we had 2 trades that hit break even, so they didn't win, but they didn't lose. And we've had 3 trades that hit TP, and they work for 2% a trade, which gives us 6. So we've done all that work and only made 1% of our trading capital. Not bad, but not great. Yeah. Again, if you was at a 1 to 1, you would be losing money, and you'd be about 3% in a loss. So on this total one, we're going to equal out to 1% profit. Yeah, we understand that. Nice and simple, away we go. So for the 1 to 4, we're going to do the same setup, and that's going to be 5 losing trades, which is going to be minus 5%. Then we're going to have 2 trades at break even, because we'll still be putting stop loss to entry on all trades. So that is then going to be 2 at break even. And then finally, we're going to have 3 trades that have hit TP, but they're now for a 1 to 4. So that's going to give us, instead of giving us 6%, it's going to give us 12% in profit. So if we have 12% minus the 5, that's then going to give us 7% in profit compared to the 1% we previously had. So now we're going to have 7% in profit. Percent in profit. So that there is the short answer on risk to reward ratio, and why basically having a bigger risk to reward ratio is better, but you can then also reverse it if you go too big. If you start going to like a 1 to 8 risk to reward ratio, you will actually probably start losing more trades or not winning as many. And the final thing I would want to master, and this is something I've had to learn over my 8.5 years of being a trader, is that I would focus on less trades and having more trading capital. And the reason you need to have more trading capital and place less trades is because you can earn more money, yeah, physical money in profits, without doing any more work. If you make 2% a month, yeah, that's 24% a year. If you've got 100,000, that means you make 24,000. If you've got 1 million, it means you make 240,000. So you've made no more work, done no more trades, no more anything, apart from have more trading capital, and we do that using funded accounts, as I talked to you about previously. So I'm going to give you 10 and 20 examples on a breakdown of understanding why that works better. As I've just done, I've done a little breakdown there, but let's say we placed 10 trades as we did previously, and we made 7%, yeah? So we got 1 to 4 risk to reward ratios. We're going to place 10 trades over, let's say, a yearly period. We place 10 trades, and we make 7% total. If I have £100,000 in a trading account or a funded account, we're then going to make 7% or £7,000 on that, because we only risk 1%, and we've made 7% in total. So we're going to end up, right, we've put 100 in, and at the end of the year we've done all these trades, and we're going to come out with £7,000 profit overall. Obviously we got to then take tax and everything like that off of it. But if you then looked at it with a mindset of, right, let's actually think bigger. I'm not going to place 20 trades where you could, so let's say we placed 20 trades instead of 10, you would end up making 14%, Yeah, so you've doubled your trades. You've gone from placing 10 trades and making 7% to now placing 20 trades a year and making 14%. So you've gone from making 7,000 to making 14,000. So you've doubled your profits. Not bad, but if you look at that in a mindset of, right, I'm going to focus on having more trading capital and keep the amount of trades I place exactly the same. So I do no more work on my trade side. All I've got to do is get some more capital. Obviously that does cost money and a little bit of energy, but a lot less risk compared to if you upped your trades. You would then go, right, let's focus on getting £1 million. So I'm going to make 7% on £1 million trading account or multiple accounts. I'd advise going on multiple, have 10 100k accounts. They're buying £1 million challenge because that's just stupid. And you would then end up with 7% still. But 7% of £1 million in funded trading capital is going to be 70,000. So you've done no more work trade-wise. You put a little bit of capital and a little bit of work into getting more trading capital itself and passing funded challenges. But you've gone from making 7 to 70, where if you would have done all that extra work, placing trades, chart analysis, everything like that, you would have gone from making 7 to making 14. So that's why we focus, and I promote this to everyone inside the Limitless Trading Club, is to actually look at getting more trading capital than actually placing more trades. So you need to work out on your strategy, and I've got another video on that went out last week, is how you can understand to work out and calculate the amount of trades you actually need to be placing to make the profits you want with the risk to reward ratio that works for your strategy. So there's quite a lot of equations towards trading, but it is simple. So now we've done the top 3 things I would want to master if I was beginning again on my trading journey. That would be risk management, risk to reward ratio, then understanding that I need to focus on getting more trading capital than trying to place loads and loads of trades every day, every week, and every month. So now you understand the 3 things you need to master to work towards being a full-time trader. I'm going to do a quick breakdown, very quick breakdown on how I would want to be the full-time trader I am quickly. So first of all, I would start with opening a demo trading account, no live accounts, and run that for 2 to 3 months. And that is so you only understood how to place trades correctly and calculate your lot sizes. So if you do mess it up and place the incorrect stuff, it doesn't matter and you don't get burned on personal capital. From there, I would try and find a mentor that is where you want to be. So whatever your dream lifestyle is, if you can find a mentor that's not full of shit and that shows you their results, then use them, pay towards that, get a mentor, get the mentorship, pay towards it, because that will halve your trading journey and the amount of effort you have to put in. From that, now you understand how to place trades and you've got a mentor that's teaching you how to trade, I would then look to put in a small amount of personal capital so that you can understand what the difference is between a demo account and trading on a live account, because that's when emotions come in. I reckon £1,000 is a good starter. It's a decent amount and it makes it easy to calculate your lot sizes. Once you've then got that set up and you've started to learn your trading, I would want to put at least 1 hour a day or 7 hours a week in towards your trading at a minimum. I would want to do that for the next 6 months. So you're going to understand in your head, 3 months is going to be first of all of placing on demos, then you're going to go to a live and do 6 months on the live account and make sure you're making profit. Once you're actually profitable on the live account, and you're making percentages, you're not going to be making any money, because 10% on a £1,000 account is £100. £100 is nothing. But you need to understand and have the mindset on trading real money. From there, I would then go, right, I'm now 9 months into my trading journey, and I am now going to look to up that amount of capital I have anywhere between £5,000 and £10,000 to your personal account. That then is going to be a point where if you're placing silly trades, it's going to burn you. So you should understand and have that already at your system on the smaller account. Then once you've made profit on that for the next 3 months, so now you're up to 12 months in your trading journey, you're at 1 year, I would then start to look at taking some of that capital out, take half of your account out if you've got 10,000 in there, take 5,000 out and actually start buying funded challenges. So then there could be 50k, 100k, 25k, whatever you kind of want. I wouldn't go for any big ones like 200, 300k, and that is because if you get a big account and you only have one big account and then you lose that account for whatever reason, if that's the daily drawdown limit or the company goes bust, you're back to zero again. So diversify, go smaller. Multiple smaller accounts is better than one big account. So then you just grow your trading capital to the amount you need. For an average trader, you're probably going to need anywhere between 300 to 500,000 in trading capital, so that you can make a good return. If you're making 1% a month, 12% a year on your trading, and you have, let's say, 300k, you're going to make £3,000 per month off of that trading. Again, if you're making 2, 3, 4% a month, then that's going to be a lot more profits in your pocket at the end of each month. So think about that. Work your way through the steps. You could be 12 months to 18 months before you make any proper money from trading, and that's still going to take a little bit of time. If anything, you're probably going to be 2 years before you start making any proper serious money from trading, where you can then look to step away from your 9 to 5. I would only stick to 3 to 5 currency pairs that you trade every week. Do not try and trade 27 currency pairs all week, every week, because one, you haven't got the time. You're still working a job, you're still trying to learn trading, you're still trying to journal everything, still trying to track all of your trades, and then also you're going to do analysis on 27 pairs every morning. Doesn't work. Try and do 3 to 5. You can understand the characteristics of each pair and what pairs move differently, because every pair does move differently, and every pair does need a different size stop loss and a little bit more breathing room compared to certain trades and setups. So that's the biggest thing to understand, is just stick to 3 to 5 trading pairs. From that, this is the biggest one for me to be profitable, is that doing 1 hour a day of back testing 5 days a week. So every morning I'll come in and do analysis, and then I will then jump on and do 1 hour of back testing on one currency pair per week. So I'll pick AUD CAD on Monday. I trade back test AUD CAD all week for 5 sessions. Then next week I'll change to a different currency pair, but stick to that currency pair. Journal all your trades with the trader's checklist, which you will find inside the Limitless Trading Club, and that will then help you understand the characteristics of each pair, as well as keeping your edge in the market when trading. And finally, for the last thing I do to keep myself profitable, is to work out the equation of how many trades I need to be placing with the risk to reward ratio that I am risking, and to the amount I want to make each year. And then from there you can work out the trades you need to place. So for me, I need to place anywhere between 4 to 6 trades per month, and that then allows me to keep the amount in, but not be too low that I only place 1 or 2 trades a month, because that may be that I'm not profitable. But then also, if I'm placing 10 trades a month, that may be too much for what I'm risking, and my strategy will not like. So try and find the sweet spot of where your strategy is and stick to that, and that will then make you the best profitable trader you can be. So if you like the content and want to watch more trading content, head over to the Limitless Trading Club, where you find a new video uploaded every Monday. If not, use the link below and you can enter into our free trading community, the Limitless Trading Club, and we will see you inside to educate yourself on becoming a better trader.